What if I told you you could invest in real estate without ever getting a 2 a.m. phone call about a clogged toilet? I've invested over $1.5 million using these 3 passive strategies. Let's be honest, most people love the idea of real estate investing. Passive income, long-term appreciation, and tax advantages? Yes, please. But the moment you mention tenants, maintenance, or property management, the dream starts to feel like a nightmare. This video is for the lazy investor. Not lazy in ambition, but lazy in the best way. Someone who wants maximum returns with minimum hassle. Why is this mind-blowing? Most new investors have one major fear: becoming a landlord. The idea of managing properties, chasing rent, and fixing leaks is daunting. But what if you could skip all that and still earn real estate returns? That's not a fantasy, it's a strategy. Actually, 3 of them. This video will walk you through the 3 best passive real estate strategies, how each one works, in plain English, pros and cons of each, my personal portfolio and returns, how to choose the right one for your goals. The 3 passive real estate strategies. There are 3 primary ways to invest in real estate passively. First, real estate investment trusts, REITs, which are ideal for people who are already comfortable investing in the stock market. These are companies that own or finance income-producing properties, and you can buy shares just like you would with any publicly traded stock. Second, real estate syndications, which are best suited for accredited investors or those ready to commit larger sums. These involve pooling money with other investors to buy large properties, such as apartment complexes or commercial buildings. Third, crowdfunding platforms like Fundrise or Realty Mogul, which are perfect for beginners or casual investors. These platforms allow you to invest small amounts in real estate deals online, often with as little as $10. 1. REITs, real estate investment trusts. What are REITs? REITs are companies that own or finance income-producing real estate. You can buy shares of a REIT just like you'd buy Apple or Tesla stock. They're publicly traded, regulated, and designed to pay out most of their income to shareholders. In fact, by law, REITs must distribute at least 90% of their taxable income as dividends. There are different types of REITs. Equity REITs, which own and operate properties. Mortgage REITs, which invest in mortgages and earn interest. Hybrid REITs, which do both. How it works. You invest in REITs through your brokerage account. They pay dividends from rental income, and while you don't own the actual property, you own shares in the company that does. Pros to REITs are highly liquid, meaning you can buy or sell them anytime through the stock market. They offer diversified exposure to different types of properties, like malls, apartments, and hospitals, and are regulated and transparent. Plus, they're accessible to anyone with a brokerage account. Cons: the downside is that REITs are tied to the stock market so they can be volatile. You also have limited control over the assets and how they're managed. Additionally, dividends from REITs are taxed as ordinary income, which can be less favorable than capital gains. My portfolio snapshot. I've allocated about $250,000 into REITs. My average annual return has been around 8–10% with quarterly dividends. It's my go-to for liquidity and simplicity. Some of my favorite REITs include VNQ, Vanguard Real Estate ETF, for broad exposure. Realty Income, ticker O, for monthly dividends. Prologis, ticker PLD, for industrial real estate. 2. Real estate syndications. What are syndications? Syndications are group investments where multiple investors pool money to buy large properties. Think apartment complexes, self-storage facilities, or commercial buildings. One person, known as the sponsor, finds the deal, manages the property, and handles the operations. You invest as a limited partner and earn passive income and a share of the profits. How it works. Typically, the structure includes a preferred return, say 8% annually, where you get paid first. After that, profits are split between you and the sponsor, often in a 70-30 ratio. Pros: syndications offer high returns, often between 12–20% annually. They come with strong tax benefits, including depreciation and write-offs. Best of all, they provide true passive income and direct exposure to real estate appreciation. Cons: however, syndications are illiquid. Your money is usually tied up for 5-7 years. You also need to trust the sponsor since they're managing the deal. Most syndications require you to be an accredited investor and have higher minimum investments, typically $25,000 or more. My portfolio snapshot: I've invested $900,000 across 5 syndications. One deal returned 18% annually, and another gave me $60,000 in depreciation write-offs. It's my favorite strategy for long-term wealth building. Some example deals I've participated in include a 200-unit apartment complex in Texas, a self-storage facility in Florida, a medical office building in Arizona, 3 crowdfunding platforms, Fundrise, Realty Mogul, etc. What is crowdfunding? Crowdfunding lets you invest small amounts into real estate deals via online platforms. It's like syndication for the masses. Platforms like Fundrise, Realty Mogul, and CrowdStreet allow you to invest in portfolios or individual deals with as little as $10. How it works: you sign up on a platform, choose a portfolio or individual deals, and receive dividends and appreciation. Some platforms offer private REITs, called REITs, direct deals you can select yourself, and auto-investing features that let you set it and forget it. Pros: crowdfunding offers low minimums, making it easy to get started. It provides diversified exposure and doesn't require accreditation. It's a great way for beginners to dip their toes into real estate investing. Cons. The cons include limited liquidity. Some platforms only allow quarterly redemptions. There are also platform fees and less control over which deals you're investing in. Returns can vary depending on the platform and the specific deal. My portfolio snapshot: I've put $350,000 into Fundrise and similar platforms. Returns hover around 9–11%, and I love the auto reinvestment feature. It's perfect for beginners. Platforms I've used include Fundrise, which is great for beginners; the Realty Mogul, which offers both REITs and direct deals; CrowdStreet, which is more advanced and has higher minimums. Comparing the strategies: let's break down how these 3 strategies compare across key dimensions. In terms of liquidity, REITs are the most flexible. You can buy or sell them anytime. Syndications are the least liquid, with your money locked in for years. Crowdfunding platforms fall somewhere in the middle, with some offering quarterly redemptions. When it comes to control, none of these options give you direct control over the properties. Syndications offer slightly more influence, especially if you know the sponsor personally, but generally you're hands-off. Returns vary. REITs typically offer 7–10% annually. Syndications can reach 12–20%, and crowdfunding platforms usually deliver 8–11%. Tax benefits are strongest with syndications, thanks to depreciation and other write-offs. Crowdfunding offers moderate tax advantages, while REITs are taxed as ordinary income. Minimum investment requirements also differ. REIs can be purchased for less than $100. Syndications often require $25,000 or more. Crowdfunding platforms allow you to start with as little as $10. Risk levels vary too. REITs are subject to market volatility. Syndications depend on the success of individual deals and the sponsor's competence. Crowdfunding risk depends on the platform's reliability and deal quality. Accessibility is another factor. REITs and crowdfunding platforms are open to anyone. Syndications are usually limited to accredited investors. Finally, in terms of diversification, REITs offer the broadest exposure across property types and geographies. Crowdfunding platforms provide moderate diversification, while syndications are more concentrated in specific deals. Which one is right for you? Let's match the strategy to your goals. If you want liquidity and simplicity, REITs are your best bet. If you're focused on high returns and tax benefits, syndications are ideal. If you're just starting out and want to experiment with low risk, crowdfunding is the easiest entry point. Here's a quick cheat sheet. If your goal is monthly income, REITs are the way to go. If you're building long-term wealth, syndications offer the best upside. If you want to test the waters with minimal risk, start with crowdfunding platforms. They're easy to use, require very little capital, and give you a taste of real estate investing without the commitment. You can start with as little as $10 and build your confidence over time. If you're focused on building long-term wealth and you're comfortable locking up your money for several years, syndications are the most powerful tool in your arsenal. They offer the highest returns, the best tax advantages, and the closest thing to true passive income. Just make sure you vet the sponsor thoroughly. Your success depends on their ability to manage the deal. And if you want flexibility, liquidity, and simplicity, REITs are your best friend. You can buy and sell them like stocks. They pay regular dividends, and they give you exposure to a wide range of real estate sectors. They're perfect for people who want real estate exposure without the complexity. Ultimately, the best strategy depends on your goals, your risk tolerance, and how hands-off you want to be. Many investors, including myself, use a combination of all three. That way, you get the liquidity of REITs, the high returns of syndications, and the accessibility of crowdfunding. The lazy investor's mindset. Let's take a moment to redefine what it means to be a lazy investor. Lazy doesn't mean careless. It means efficient. It means strategic. It means choosing investments that work for you while you sleep, travel, or spend time with your family. It means leveraging systems, platforms, and professionals to do the heavy lifting, while you collect the returns. You don't need to be a landlord to be a real estate investor. You don't need to fix toilets, chase rent checks, or worry about termites. You just need to know where to look. And once you start seeing those dividends hit your account without ever fixing a leaky faucet, you'll wonder why you didn't start sooner. My $1.5 million passive real estate portfolio breakdown. To give you a real-world example, here's how I've allocated my own money across these strategies. REITs, $250,000. Average annual return, 8–10%. Liquidity, high. Use case, short-term flexibility and dividend income. Syndications, $900,000. Average annual return, 12–20%. Liquidity, low. Use case, long-term wealth building and tax optimization. Crowdfunding platforms, $350,000. Average annual return, 9–11%. Liquidity, medium. Use case, diversification, and low-effort investing. This mix gives me the best of all worlds. Consistent cash flow, long-term appreciation, and the freedom to live life on my terms. Real questions from real investors. Here are some common questions I get from people considering passive real estate investing. Q. Can I lose money in these investments? Yes, just like any investment, there's risk. REITs can drop in value, syndications can underperform, and crowdfunding platforms can mismanage deals. That's why diversification and due diligence are key. Q. Do I need to be accredited to invest? For syndications, yes. You typically need to meet income or net worth requirements. But REITs and most crowdfunding platforms are open to everyone. Q. How do I vet a syndication sponsor? Look for experience, transparency, and a strong track record. Ask for past deal performance, references, and detailed business plans. If they're vague or evasive, walk away. Q. What about taxes? REIT dividends are taxed as ordinary income. Syndications offer depreciation and other write-offs that can significantly reduce your tax bill. Crowdfunding platforms vary. Some offer tax-advantaged structures, others don't. Tools and resources to get started. If you're ready to dive in, here are some tools and platforms I recommend. For REITs, Vanguard, VNQ, Fidelity Real Estate Index Fund, Schwab, US, REIT, ETF for syndications, PassiveInvesting.com, Ashcroft Capital, Spartan Investment Group for crowdfunding, Fundrise, Realty Mogul. CrowdStreet. Also consider joining real estate investing communities like Bigger Pockets or subscribing to newsletters from trusted sponsors. Education is your best defense against bad deals. Final thoughts? Real estate doesn't have to be messy, stressful, or hands-on. You don't need to be a landlord to build wealth through property. With the right strategy, you can earn consistent returns, enjoy powerful tax benefits, and sleep soundly knowing your investments are working for you. Whether you're starting with $100 or $100,000, there's a passive real estate strategy that fits your lifestyle. So embrace your inner lazy investor and let your money do the hard work.